Welcome back to the Daily Crypto Deep Dive. And today, we're pulling back the curtain on one of the most misunderstood parts of the entire digital asset world: staking. It's the quiet heartbeat of the modern blockchain economy, a system that pays holders to keep the lights on. On the surface, it sounds simple: lock up your coins, earn yield. But underneath that calm facade lives a story of competition, control, and the subtle return of centralization in a movement that promised the exact opposite. So what actually happens when you stake your crypto? Why do yields rise and fall? And could the very system that's meant to secure blockchains be putting them at risk? Over the next few minutes, we'll take you from the basics of how staking works to the deeper mechanics shaping the trillion-dollar proof-of-stake revolution. And yes, we'll expose a few uncomfortable truths along the way. Let's start where it all began: the transition from proof of work to proof of stake. When Bitcoin launched back in 2009, mining was the model. You ran computers, solved cryptographic puzzles, and whoever proved they'd spent the most computational power earned the right to add the next block and collect rewards. It was brilliant, but it was also brutally inefficient. As networks grew, energy use skyrocketed, and smaller miners were pushed out by industrial farms. So the crypto community started asking, could you prove commitment without burning electricity? Enter proof of stake, a different kind of game where, instead of spending energy, you lock capital. Validators put up collateral, staking their own coins, to earn the chance to process transactions. The logic is simple: if you behave honestly, you earn yield. If you cheat, you lose your stake. In theory, it aligns incentives better than proof of work, because participants literally have skin in the game. Ethereum's merge in 2022 turned that theory into mainstream reality. After years of testing, Ethereum's network stopped relying on miners and flipped the switch to proof of stake. Since then, staking has exploded. Today, roughly 64% of all circulating Ethereum is staked, more than 75 billion USD worth of locked collateral. Solana and Cardano boast similar numbers, each with well over 60% of supply staked. Across all major proof-of-stake networks combined, analysts estimate more than $400 billion in crypto is now earning yield through staking contracts. But what's fascinating is how misunderstood those yields are. Many casual investors think staking is like earning interest in a savings account. It isn't. Staking rewards don't come from lending or counterparty obligations. They're minted by the protocol itself, distributed from inflation and network fees. You're being paid in new tokens for helping secure the chain, not for letting someone else borrow your assets. That distinction matters because your real return depends on inflation, validator performance, and price movement. Take Ethereum, for instance. Its base reward rate right now hovers around 3.1%. But that fluctuates with the total amount staked and with network activity. When fewer coins are staked, individual rewards go up to attract more validators. When more are staked, yields compress. Solana's rewards, by contrast, sit closer to 7%, though the effective yield after inflation is closer to 4%. Cardano pays about 3.5%, while Avalanche and Polkadot float in the 8 to 10% range. But again, those are nominal yields. If the token price drops 20% in a month, your real return might still be negative. What's changed since 2022 is that staking has evolved beyond being purely technical. It's now a competitive industry. Validators, essentially the new miners, operate large data centers to run nodes, maintain uptime, and attract delegations from everyday holders. And in many networks, those validators are starting to look awfully familiar. Coinbase, Binance, Kraken, Lido. The giants of centralized finance now dominate the validator landscape. On Ethereum, for example, more than 30% of all staked coins flow through Lido Finance, a liquid staking collective run by a handful of major operators. Coinbase alone controls about 13% of validator nodes. So the question emerges: have we just swapped one form of centralization for another? Developers insist no, because validators can be replaced at will and the barrier to entry is lower than industrial mining. But critics argue otherwise. The more tokens that flow into pooled staking products, the more control concentrates in a few hands. And with control comes influence over governance, over block ordering, even over censorship. Remember when certain validators briefly censored Tornado Cash-related transactions to comply with US sanctions? That was a glimpse of the fragility hiding beneath the decentralization narrative. Still, for the average holder, staking feels like easy money. You open your wallet, hit stake, and watch your balance grow. Some use native delegation, pointing their stake to a validator they trust. Others prefer liquid staking tokens, or LSTs, which let them trade their staked position while still earning rewards. That innovation, introduced during the last bull run, made staking truly liquid and massively increased participation. It also created new risks, because when those derivative tokens start circulating widely, the link between the derivative and the underlying stake can break under stress. We saw a preview of that during the 2022 to 2023 liquidity crunch, when stETH briefly traded at a 7% discount to regular ETH. Panic spread fast. Suddenly, a supposedly risk-free yield turned into a liquidity trap. And that brings us to the economics of staking. Each blockchain sets its own inflation rate and reward schedule. The trick is finding equilibrium, enough reward to incentivize validators, but not so much that inflation destroys value. Ethereum cleverly links rewards to activity. During high fee periods, when users are paying gas, the network actually burns a portion of those fees. Some days, the net supply even shrinks, making Ethereum deflationary despite paying staking rewards. Solana, meanwhile, maintains steady inflation but offsets it with blazing transaction volume. Cardano distributes rewards from a fixed reserve that diminishes each epoch. Different mechanisms, same goal: sustain security without killing token value. At its core, staking turns blockchains into self-funding economies. Instead of miners selling coins to pay for electricity, validators recycle part of the network's inflation. It's cleaner, more predictable, and, in theory, more sustainable. But the narrative of passive income hides how dynamic the system truly is. Every staker, knowingly or not, is making an economic bet on network longevity, validator honesty, and regulatory clarity. Analysts at MiCA recently called staking the first truly native yield in digital finance. They're right. It's not yield manufactured by leverage, it's built into the consensus mechanism itself. Yet, as staking grows, so does systemic risk. A misconfigured validator can get slashed, losing part of its stake for downtime or misbehavior. In 2024, several small operators on Cosmos lost over $400,000 collectively to slashing penalties. On Ethereum, slashings remain rare, but they happen, mostly due to operator mistakes rather than malice. For everyday delegators, that's why due diligence matters. If your validator fails, you share the pain. Now, let's zoom out. Globally, staking has matured into a trillion-dollar backbone of the industry. Research by Staked US and Kraken Intelligence estimates that as of 2025, roughly $425 billion worth of crypto assets are staked across networks, generating over $25 billion annually in rewards. That makes proof of stake the single largest source of organic yield in the entire crypto ecosystem, larger than DeFi lending, derivatives funding, or NFT royalties combined. It's not hype anymore, it's infrastructure. Still, the quiet question hanging over staking is whether it's sustainable. Every economic system faces entropy. If rewards outpace real usage, inflation rises, prices fall, and the yield illusion fades. Ethereum's designers anticipated this. That's why burning fees keeps the supply in check. But smaller networks without equivalent fee volume rely entirely on inflation to pay validators. That creates a treadmill effect. The network must keep growing just to justify its rewards. Some won't make it. In 2023 and 2024, dozens of minor proof-of-stake chains quietly died. Not because of hacks, but because participation dropped below viable thresholds. Validators left, yields dried up, and consensus collapsed. Which brings us back to why staking remains both fascinating and fragile. It's the future of crypto consensus, but also a mirror of crypto's contradictions, decentralized in code, yet increasingly concentrated in practice. Sustainable on paper, yet vulnerable to human incentives. The evolution of staking didn't stop with simple delegation. As the market matured, new ideas began reshaping how people thought about securing networks, and how they could squeeze more value from the same capital. The result was a new buzzword that dominated 2024 and 2025 alike: restaking. If staking is like renting out your capital to help a blockchain run, restaking is like taking that same capital and leasing it again for extra work. It's the financial equivalent of stacking yield on yield, and it's the hottest topic in decentralized infrastructure today. The concept started with projects like EigenLayer on Ethereum. The idea was straightforward but revolutionary. Let staked Ethereum, or liquid derivatives, be rehypothecated to secure other services beyond the base chain. Think data availability layers, Oracle networks, or even cross-chain bridges. Instead of each service bootstrapping its own validator set, they could borrow Ethereum's security through restaked assets. At first glance, that seems efficient. It deepens utility for staked capital and incentivizes validators to provide new types of security. But as with every innovation in crypto, the devil hides in the incentives. Critics argue that restaking blurs the clean boundary between staking for consensus and speculating for profit. If one of those restaked services collapses or gets exploited, could it drag Ethereum's validators down with it? Some developers think yes. Vitalik Buterin himself warned in early 2024 that over-leveraging Ethereum's security could create systemic contagion risks, where one layer's failure ripples upward into the base protocol. Still, despite those warnings, EigenLayer's deposits blew past $12 billion within months. In crypto, risk often loses to opportunity, especially when the APR flashes double digits. And that's what makes staking so fascinating right now. It's evolving from a technical consensus system into a full-blown capital market. Validators aren't just keeping the network alive, they're managing yield portfolios. The more sophisticated ones run multiple validator clients across ecosystems, balancing exposure between Ethereum, Solana, Cosmos, and Avalanche. The biggest of them now resemble hedge funds, complete with proprietary monitoring systems, algorithmic rebalancing, and insurance pools to cover slashing events. Analysts at Delphi Digital have warned that this looped staking activity could create soft leverage bubbles, similar to the yield farming craze of 2021. When everything's going up, it looks brilliant, but when prices dip or liquidity dries up, those derivative positions can unravel fast. Remember, every LST relies on the underlying validator network functioning perfectly. If withdrawals ever pause, even briefly, trust evaporates. Still, despite the complexity, staking has become a backbone of modern crypto stability. During bear markets, when speculative trading quiets down, staking income provides predictable cash flow. It's why long-term holders often call it their sleeping yield. It smooths volatility, encourages holding, and locks up supply, all stabilizing forces for token economics. Yet, regulators see a different story. In the eyes of the SEC and other agencies, staking looks suspiciously like offering yield-bearing securities. After all, you're investing an asset and expecting profit from someone else's managerial effort. The classic Howey test argument. It's why the SEC cracked down on Kraken's staking program in 2023, forcing them to shut it down in the US and pay a $30 million fine. Coinbase faced similar scrutiny, though it managed to keep its program alive by structuring it as a pass-through service, not an investment contract. Europe has taken a more nuanced approach. Under MiCA, the EU's comprehensive crypto framework, staking is recognized as a legitimate network function, but providers must clearly disclose risks and reward structures. It's regulation by transparency, not suppression. Asia, meanwhile, continues to embrace staking wholesale. Singapore, Japan, and Hong Kong have all authorized institutional staking funds, allowing banks to offer tokenized staking exposure to clients. This split in global policy highlights the tension between innovation and control. Staking empowers individuals to earn yield directly from networks without intermediaries, but it also undermines the state's monopoly on interest-bearing assets. When a retail investor can stake Solana and earn 7% with no bank, what happens to the traditional savings model? That's why some regulators quietly call proof of stake shadow finance. It's a decentralized version of monetary policy running in parallel to fiat systems. From a technical perspective, staking's next frontier is modularity. Instead of single monolithic chains where validators handle everything, new networks are decomposing consensus into layers: data availability, execution, validation, each with its own staking market. Celestia pioneered this model, offering modular data availability secured by staked TIA tokens. EigenLayer is doing the same using restaked Ethereum. The result is a new marketplace for security itself, staking not just as infrastructure, but as a tradable commodity. It's a logical evolution. In the traditional world, nations sell bonds to borrow security, promising repayment for trust. In crypto, protocols offer yield to rent security, promising tokens for trust. And just like sovereign debt, not all security is equal. Ethereum's validator base carries premium yield for reliability. Smaller networks must offer higher rewards to attract risk-tolerant capital. The free market has discovered the price of decentralization. But here's the irony. As staking becomes more financialized, it becomes less ideological. Early Bitcoiners rallied around the purity of don't trust, verify. Proof of stake asks for something different. Trust, but stake. You're outsourcing validation to an economic majority, and the assumption that their financial interest keeps them honest. In practice, that works remarkably well. Proof of stake chains have proven secure at scale, but philosophically, it shifts crypto from an adversarial model to a cooperative one. The network's integrity now depends on aligned incentives, not raw computation. And those incentives are evolving fast. Some projects are experimenting with active staking, where validators can dynamically adjust slashing risk and reward based on real-time performance metrics. Others are exploring reputation-weighted staking, combining identity proofs with capital commitment. The goal is to blend accountability with efficiency, turning staking into something more meritocratic than purely financial. So where does that leave us? Probably in the middle of another transition, one that's far from over. Staking is still young, still messy, and still misunderstood. But it's also the purest expression of what crypto was meant to be. A system where participation equals power. The future won't belong to those who merely hold their coins. It'll belong to those who put them to work. If you've learned something new today, follow the show and drop a 5-star rating. It helps the algorithm and keeps this independent crypto coverage alive. And remember, this is education, not financial advice. Do your own research, use your own wallet, and never risk what you can't afford to lose. Crypto's future is being built, staked, block by block, and we'll be right here, breaking it down, one deep dive at a time. We'll see you at the top.